Hi everyone, so today we're going to be looking at prepayments. Prepayments made easy. We're going to understand what prepayments are and how to account for them. And I just want to remind you that we covered the accruals and the matching concept before. So prepayments arises as a result of the matching concept. Now, prepayments, the main situation where they arise is where you have a purchase invoice. You got it before the year end, but it relates to after the year end. So you better make some adjustments, pal, otherwise you're in trouble. Okay, this is best understood with an example. So we have company XYZ preparing financial statements for the year 31st of December 21. We have a rent invoice for 12 months to 31st of May 22 of £12,000, and that needs to be processed. It was received on 17th of May 21. Okay, so it's received before the year end. How do we treat this in 21 using the matching concept? So I draw out my timeline because I'm a good boy, and I'm going to record when the invoice relates to. So the end of the period was 31st of May 22, and the beginning of the period was 1st of May 21. What's the bit in the middle? Well, that's the year end date, so 31st of December 21. I was kind, so I picked an easy date for us to remember. So this gives us 5 months, and that gives us 7. And this 5 has been, if you like, prepaid. And as you know, we're studying prepayments, so think about that for a minute. Now, the invoice comes through, so before the year end, so we have to do something about it. Okay, we have to just quickly deal with it and then make the prepayment adjustment. So the invoice comes through, we're going to put the whole amount to expense, so debit expense 12,000. And we're going to cut the credit to trade payables, our best friend. So trade payables is the amounts you owe to suppliers. So there is an obligation because you have to pay the trade payable. We have to pay the supplier £12,000. Okay, so we got the invoice, we dealt with that, but what's the issue? Well, a portion of it relates to next year. So we have to adjust the expense amount. Because remember, expense is to do with when the period it relates to. Okay, so what part relates to 21 is the 7. It's the 7 here. Okay, now what's the prepayment going to be? Okay, so the portion of the amount that is prepaid is 5/12. Okay, so we know that 12 months corresponds to £12,000. What does 5 months correspond to? Well, it's easy. It corresponds to 5/12 multiplied by 12,000. And what does that give us? £5,000. What does this mean? Well, it means that your prepayments, so we do debit prepayments. We put credit expense because what I want to show you actually first is that the expense is going down by £5,000. Okay. So debit and debit prepayments we're going to now do, and that's also £5,000. And I want to put what I want to point out is that prepayments is an asset, because you're going to get the benefit of the service later on, and it's therefore on the soft P or the balance sheet. Okay, right, what else did I want to raise? Well, I'm going to color, so debit expense 12,000, we've done credit expense here. right? So if I think of the debit as positive, so I've done positive £12,000. I've done less £5,000. And what does that give me? It gives me £7,000. So actually, the 7 months here, the expense we should be recording is £7,000. Okay, so let me £7,000. Let me just use this to help with this question. Okay, so we had 31st of December 21 here. We had 31st of May 22 here. And you had 31st of May 21. Okay, so we knew that £5,000 was on this side and £7,000 was on this side. Firstly, I want to ask you what expense needs to be in 22. It's going to be the 5,000, isn't it? So we need to recognize, we should, at the end of all of our transactions, be recognizing an expense of £5,000. Okay, now I'm just going to draw some T accounts. I'm going to show you what happens to the prepayment. So last year we had a prepayment, we have a prepayment brought forward of how much? We have a prepayment brought forward of £5,000. Our expenses here. Now expense is always zero, isn't it? It's always zero at the beginning of the year. So the prepayment, do we need it? Not anymore, because that related to last year. So I'm going to put 5,000 here. And I'm going to put the 5,000 here. Okay, so what we've done is debit expense 5,000. And we've done credit prepayment 5,000. So we've done the opposite entry to what we posted before. Does that actually make sense? Well, let's have a think about it. So our expense we were expecting was £5,000. And look at the expense we have got as a result of the adjustment. We've actually got £5,000 here. So as you can see, it all works out and everybody got married again. Okay. What did I want to point out? So in this case, it's much simpler, isn't it? So what I want to say is as well, for prepayment, so I know we've reversed it out, so the prepayments is currently nil. And that means we're going to put next year, this year, we're also going to record another prepayment based on the next invoice, if you like. So probably the next invoice is going to go to 31st of May 23 instead. So in summary, prepayment relates to next year. It's a reduction in an expense and an asset. Firstly, you record the full invoice amount. We then reverse out the part that relates to next year. The part that relates to next year is called the prepayment. And then we release it in the next accounting period by doing debit, expense, and credit prepayments. Okay, it wasn't quite 5 minutes, but I'm sure it was short enough for you to not fall asleep over. So thanks everybody, have a nice day.